Thank you. I'll be there. Kwani Grace akwenda na MC?
Good. Kwa sawa sasa. So we are back. Let's continue. Can you hear me now? Can you hear me? I think my microphone is good now. So just confirm if you can hear me. The microphone is good. Test. Okay. So just confirm with one of them. So I'm ready to begin the class. It's an introduction. So I believe you can hear me. I can see my microphone is good. Oh yeah, it's good. So as I was saying, my name is Victor. I'll be taking you through the training, and we usually have it every day if you are available. And also we have news events. Can you hear me? Oh no. Oh, do we begin again? Mute my audio more. Can you hear me? Can you hear me? Someone has texted, not yet. Yes, Kamu can hear me. Okay, I'll be audible enough now. So let's begin again. Just a minute. Let's continue now. So I'll be taking you through introduction to Forex trading. This will be the syllabus. So we'll send the material. The material, we are going to send it to your class group on WhatsApp. So not to worry about that. So, but I don't know. I think most of you are new to trading. So this is more or less what we'll be tackling. Let me put this down here. Yes, there. So we'll first come to tackle Forex, or what is Forex trading. Then we'll go to the terminologies. Basically, what terminologies do we use? We also have long or short order types and calculating profits and losses. You need to understand, at the end of the day, it's a business just like any other. And when you're starting a business, you need at least to be able to know you are in to make money, not to lose. So we need, here we'll be able to calculate profits and losses. We'll also be able to, someone has texted, cannot hear you. Wow. What about now? I'm trying to be audible enough. So we'll also tackle what is professional Forex trading. We'll also tackle fundamental analysis. And then there is something we usually call price action trading analysis. So, yeah, that's okay, okay. I think we are clear now. So let's continue. We're also recording the class. So we are going to send the link for the video to you. So price action. Price action, we'll be able to understand what is price action. Then part 7, this is usually very, very important for you to, as you start, Forex charting. What is Forex charting? Or basically looking at the charts, being able to understand top-down analysis. Are the markets going up? Are the markets coming down? Or are they also going sideways? Like most of December, I have 2 more people joining. So just a minute. Okay, let's continue. So introduction to Forex charting, price action trading analysis, and also the most important thing for you as you begin in this career in trading is coming up with a Forex trading strategy. And for that, there's also another material I'm going to send to you about Forex trading strategies. I have very many, over 200 or 300. So there's a whole book. But the most important thing will be to understand what type of a trader are you, because we are usually different. There are people who are day traders. We also have scalpers. We have swingers and different types of trading. So depending with your personality, which best trading style suits you. So that will be number 8. Then we also have common trading mistakes and traps. This is very, very important, part 9, for us to understand what are the mistakes or what are some of the mistakes and traps that most of the traders or most of beginners make, and for you how to avoid them. Then we also have technical analysis. This is very, very, very important, because now technical analysis is the way to be able to read the charts. When you look at the markets, you'll be able to understand how the markets are performing. So when you combine technical analysis and part 5, fundamental analysis, you'll be able to really understand what really happens in the market. So let's continue. Then part 11, how to make a Forex trading plan. So after the whole course, or after the whole course, you'll be able to understand how to make a Forex trading plan. And then a Forex trading plan is, what's your plan on Monday? What's your plan on Friday? During the weekends, what do you do? How are you able to look at the markets and really understand what's really happening in the markets? Then part 12, the psychology of Forex trading, because there's a psychology. There's usually a lot that happens during the markets, or when the markets are happening, or when you're trading. There's a psychology behind it, and most people, they usually say 95% are losing. So why are 95% losing? Here we'll be able to understand part 2 of the psychology of Forex trading. So I'll just give you a brief introduction, because this is the first class. I think you had talked with Maureen. She told you what is supposed to happen. So I'm going to give you an introduction on to Forex trading. Then from there, we'll be going into depth to what Forex is all about. So we'll tackle the basics. So this should be basically, the Forex market is where banks, businesses, governments, investors, and traders come to exchange and speculate on currencies. So for you to use shillings, or for a guy who comes from abroad, let's say a tourist, when they come here, they're able to exchange their dollars. When they exchange their dollars to shillings, they cannot go to the hotel or whatever. They cannot do business here with the dollars. They have to go to the bank and exchange their dollars to shillings. So when they do that, they're taking part in the Forex market. It is also referred as the FX market, currency market, or foreign exchange currency market, or foreign currency market. And it is the largest and most liquid market in the world, with an average turnover. So it has doubled. So right now we are at 7.5 trillion. So I'll have to edit this. So you have to understand, every day there's a turnover of $7.5 trillion. So it's a lot, because you can see we have banks, all the businesses, governments, they have to always be able to check how's the currency performing. For example, what's the shilling rate between now and the dollar? How much was it 2 months ago or 3 months ago? We'll be handling that. We'll also be tackling inflation, understanding why the price of goods and services, why they go up or why they are coming down. It is open 24 hours a day, 5 days a week, with the most important world trading centers being located in London, New York, Tokyo, Zurich, Frankfurt, Hong Kong, Singapore, Paris, and Sydney. So it should be noted that there is no central marketplace for Forex trading. Instead, it is said to be conducted over the counter, or OTC. OTC means, as long as you have an internet connection, as long as you have a phone, or you have a laptop, wherever you are, or a tablet, you can be able to come in and be able to participate in the Forex market or Forex trading. It is not like stocks, where there's a central place. So for you, for example, here in Kenya, if you are to go to buy stocks, you have to go to look for a CDS account, go to the NSE trading floor. There's a central marketplace with all orders processed. For example, the New York Stock Exchange. But Forex is a product quoted by all major banks, and not all banks will have the exact same price. So I need you to understand, what is Forex? It is a product. That price, you usually go to the bureau to get one. Yesterday was 159.5 the dollar against the shilling. If you find another bank giving you 160, that's what they are quoting. That's the product. So I need you to really understand that it is a product quoted by all major banks, and not all banks will have the exact same price. Let me mute someone else here. Okay, now the broker platforms takes all these feeds from the different black banks, and quotes we see from our broker are an approximate average of them. It's the broker who is effectively transacting the trade and taking the other side. So when you buy, there is always another guy on the other side taking a sell. There has to always be a balance. When you sell the orders, there's someone else taking a buy. The reason this happens is so that we can create something we call liquidity. Liquidity is what moves the market. This 7.5 trillion, there will always be buyers, and other guys are always selling. So I need you to understand, every time you're buying, the broker will always have a lot of money. For you to be a broker, at least you need an extra $3-4 billion. So that happens so that we can have a balance, or an equilibrium. Let me use that word. They make the market for you. Making the market means you can be able to enter, buy, sell, make profit, withdraw. That's what usually happens. But we have different types of brokers. So that one we'll handle later. You have non-dealing and dealing desk. So that one I'll be able to explain on the next class when you guys will be in, so that you really understand what really happens. So when you buy a currency, your broker is selling it to you, not another trader. You can see what I was meaning. When you're buying, your broker is selling it to you. When you're selling, your broker is doing what? Is buying, not another trader. So then I'll tackle a little bit of history. This one will be very fast. So it's a little bit boring, but important to have a little background of the history of Forex market so that you know how. So in 1876, we had something called a gold exchange standard that was implemented. It said that all paper currency, so every paper currency was supposed to be backed by solid gold. The idea here was to stabilize world currencies by pegging them to the price of gold. We understand that gold never loses its value or its luster. It never loses that luster because over a period of time, 4 years, 5 years, 10 years, it still has that store of value. That means it keeps gaining. It never loses its value. So that's why it was pegged to gold. So it was a good idea in theory, but in reality, it created boom bust patterns, which ultimately led to the demise. So the reason why they had to do away with it is because during the beginning of World War II, major European countries did not have enough gold. Gold is scarce. That's why it's very precious. For you to come across pure gold, it's hard. So to support all the currency they were printing to pay for the large military projects. Although the gold standard was ultimately dropped, the precious metal never lost its spot as the ultimate form of monetary value. I need you to understand this is a very important key point. This one, ultimate form of monetary value, because when you'll be trading, I'll be able to be showing you that most of the currency, especially the dollar, will be always be able to see the dollar against the gold or gold against the dollar, because every time the dollar is losing, gold is usually gaining. Every time gold is losing, dollar is usually gaining. So that one, but I'll handle it when we enter into technical analysis. I'll do the charts, and we'll also be able to be doing technical analysis together. Like yesterday, I sent guys on WhatsApp the technical analysis for CPI. So we'll also be handling those fundamental analysis. So the world then decided to have fixed exchange rates that resulted in the US dollar being the primary reserve currency, and it will be the only currency backed by gold. So this is now it was easier. It was called the Bretton Woods system. So that means the dollar only the dollar was pegged to gold. So the other paper currency were not pegged to gold. So, and this would only this is known as Bretton Woods system. I know it's exciting. So in 1974, the US declared that it would no longer exchange gold for US dollar that were held in the foreign reserves, and this marked the end of Bretton Woods. So let's finalize on the history. It was this breakdown of Bretton Woods system that ultimately led to the global acceptance of floating foreign exchange rates in 1976. So if you do your math, you have almost 4 or 5 decades since 1976. I think 4 or 5 decades or plus. This was effectively the birth of the current foreign or the current foreign exchange, or basically what we call FX. Although it did not become used until 1990. You know, when the internet was born. Okay, let's move. So what is it? So now, what is trading? Who, what, where, how? Questions. Now, these are the questions I'll be answering. So it relates to retail traders. Retail traders is me and you. When you're on your computer or your smartphone or your tablet, whatever you're using, and you want to make some extra 20, 30, 40, $50 in the market. That is you and me. That's what we call retail traders. You and I is the speculation on the price of one currency against another. So I need you to understand Forex trading relates to retail traders, you and I, and it is the speculation on the price of one currency against another. For example, if you think the euro is going to rise, so Europe is doing well, the markets have been good, jobs are being created, manufacturing industry is doing well, and basically more people are having money in their pockets. The more they keep using that money, we are speculating that the euro is going to rise against the US dollar. So when that happens, you can buy the currency called euro against USD. So when you do that, you currency pay a low and then hopefully sell it at a higher price. When you're buying and making profits, you will sell it later on, and that's when you do what? You make a profit. Of course, if you buy the euro, now this is the opposite. Say we buy the euro, but then the dollar strengthens, then you'll be at a losing position. So I told you we need to be able to calculate both profits and losses. It's a business like any other, and Any business can have profits or losses. But now I'll be teaching you a way where you make at least 80-90% you're making wins. It's very, very easy, but there's so many secrets that I'll be able to be teaching you over the course of this curriculum. So it's important to be aware of the risk involved in trading and not only the reward. So one thing I need you to understand, there is always a risk reward ratio. What's your risk reward ratio? Is it 1:2 or 1:3? If I'm risking, am I risking 1 to make 2 or 3 times the currency, the profit that I'm going to make? So that's what we usually call risk reward ratio. Risk 1 dot reward. How much do you want? Do you want to make 2 times or 3 times? But that one I'll be handling it later with most of you who will be continuing with the course. So why is it so popular? Being Forex trader has a most amazing potential lifestyle of any profession in the world. It's not easy to get there, but if you're determined and disciplined, you can make it happen. So this is why I would love you guys to be involved in the Forex market. Number one, ability to take a loss without becoming emotional. Sometimes the market will not favor you. So sometimes it will not give you the results you want. So you have to learn to take a loss and don't be emotional about it. Be very, okay, I took a loss, I'm okay with it, tomorrow will be a better day. Confidence. You have to learn to believe in yourself and your trading strategy and have no fear. So when you're starting, this will be one of the most important traits, because most people usually have a lot of fear. Fear of starting, fear of how will I make money, or fear of I've made a loss, can I make it back? Dedication to becoming the best Forex trader you can be. So it is a skill you have to develop over and over and over again. Then there is discipline, remain calm and unemotional in a realm of constant temptation. So the market will always be tempting you. Sometimes you're seeing a buy, sometimes you're seeing as you're like, today I can make $100, today I can make 50. So you have to always remain calm. Discipline, discipline, discipline. For this class, if you will not remember anything, remember one thing I've told you: discipline, discipline, discipline. That is very, very, very important, because the moment you're disciplined, you'll always be able to come in the market and be able to make some nice, good money, even if it will not be a lot of money, but at least constantly. If you are to make $20 every day for 5 days, that's $100. $100 times 4, that's $400. Even if you had $200 or $300 in the account, my friend, that's really, really good money. So flexibility, trade, changing markets successfully, then focus. You have to stay concentrated on your trading plan. So as I've told you, we'll come up with a trading plan after the whole course, so that now you will be able to be handling the trades on yourself. For me, I'll be your guide. I'll be able to guide you, to be showing you this is this and this, because at least I have seen the ups and downs. I have made mistakes also. I'll show you the mistakes I was making. But for you, it will be easier for you because you have someone who's guiding you. One thing about this business, it's good to always have someone we call a mentor. A mentor is someone who got there before you, and he will be able to help you avoid the mistakes, especially of losing. So focus. You have to really stay concentrated on your trading plan and do not stray off course. Focus, focus, focus. Remember that. So another thing, logic, to look at the market from an objective and straightforward perspective. You have to always think logically. Remove the emotion. The way you do 1+1 is 2. What if 1+1 is 1? Anyway, I'm just saying. Organization, to forge and reinforce positive trading habits. So one thing we do every Friday or every Monday is to be able to look at the markets and see during the week, what did you do? Did you make money? Did you make a loss? What were the mistakes you made? And that way you're able to enforce or reinforce positive trading habits. Patience, to wait only for the highest probable trading strategy. This is very, very important. Buy low, selling high, meaning we are always taking opportunities that we can see. Highest probability trading strategies according to your plan. Realism, to not think you're going to get rich. So number one thing I want you to understand, it's not a get rich quick scheme. It's a business. Just me usually target 2% per day or 3%. If I make more, then better. But 2 to 3%, even if I'm having $100, that's roughly 10. Or oh no, if I'm handing $200, 10% is $3, $4. But if I do that consecutively for like, say, 10 times, now I have $3 10 times, that would be $30. If you have $30 from $100, that would be 30%, which is a lot. Is it 30%? Yeah. Because $10 is 10%. So if you consistently do that over 100 trades, then you will realize you're compounding and you're making money. So this is very, very important, to not think you're going to get rich, but understanding the reality of market and trading. Survey, to take advantage of your trading edge. And when it arises, then be aware what is happening at the market all times. This will be news. There is so many news happening. You guys saw Hamas and Israel fight. Last year we had Ukraine war. I think it's still going on. These are some of the things or happenings that usually control. We usually call them geopolitical tensions and all that. Self-control, to not overtrade and over leverage your account. So that one is also very, very important. As traders, don't worry, we are going to restart. I have another PDF I'm also going to share with you. Let me first finish this. So as traders, we can take advantage of the high leverage and volatility of the Forex market by learning and mastering an effective Forex trading strategy, building an effective trading plan around that strategy. Remember, first we are learning and mastering an effective trading strategy. That's why we are here. Then after that, we will build out of that strategy an effective trading plan around the strategy. And then we will follow it, that strategy and trading plan, with ice cold discipline. Remember discipline, discipline, discipline. Money management is key here. Leverage is a double-edged sword and can make you a lot of money fast or lose you a lot of money fast. So remember, we'll talk about leverage. So in the next PDF, I'll be showing you what is leverage. Then the key to money management in Forex trading is to always know the exact dollar amount you have to risk before entering a trade and be totally okay with losing that amount of money. Because any one trade could be a loser or even a winner. So money management is risk, have risk, small risk, 1 to 2%. We always have that discipline. You always risk, you only risk what you can afford to lose. So money management will be very, very important. So these are the guys who trade Forex, central banks, institution. I'll share this with you, don't worry. Commercial banks, Forex brokers, individuals, companies, and so forth and so forth. So banks, the interbank market always allows for both majority of commercial Forex transactions, the large amounts of speculative trading each day. Some large banks will trade billions of dollars daily. Sometimes this trading is done on behalf of customers. So if you put your money in the bank, most of this money has to go, or a portion of it has to come into the Forex market. That's the only way also the banks are able to make money. Then we have companies. Companies, they need to use the foreign exchange market to pay for goods and services from foreign countries and also sell goods and services to foreign countries. It's called balance of trade, exports and imports. I know you guys understand what are exports. Exports are what your country is selling to other countries. Imports are what your country is buying from other countries. So this is very important part, because if you are buying goods from Europe, we'll have to buy them in euros. When they hit here, the bank has to go back, look at the exchange rate of the euro versus the shilling. So that's where the companies come in. So it's a very important part of the daily Forex activity, comes from companies looking to exchange currency in order to transact in other countries. So we'll be tackling this. It's called balance of trade, or the imports and exports. Is very, very important in fundamental analysis. I'll be dealing with it in depth later. Governments also, central banks, interest rates. For you to borrow a loan, you have to go look for the interest rates. Okay, no problem. A country's central bank can play an important role in the foreign exchange market. They can use an increase. This is what I was saying, an increase or decrease in the value of nation's currency by trying to control money supply, inflation, and or interest rates. So we are also going to be tackling this in depth, something called inflation, supply, but mostly interest rates, because these interest rates are what govern the Forex market. This one we'll be tackling mostly in the next class when I introduce a little bit of what is fundamental analysis. They can use their substantial foreign exchange reserves to try and stabilize the market. Then hedge funds, somewhere around 70 to 90% of all foreign transactions are speculative in nature. This means the person or institution that bought or sold the currency has no plan of actually taking delivery of the currency. Instead, the transaction was executed in the sole intention of speculating the price movement. So these hedge funds, they're like you and me. Retails, you and we are small cheese, but now the hedge funds, they are moving billions and billions of dollars. They are companies who deal with wealthy clients and trade for them in exchange for a profit. Then we have individuals. You have traveled to a different country and exchange your money in a different currency at the airport or bank. You have already participated in the foreign exchange currency. Say you're planning to travel, or you in future you'd love to travel, go to Europe, US, or whatever country. You will need to go and exchange your money to that country's currency. You'll be participating in the foreign exchange market or the Forex market. Basically, it revolves around us. You cannot do away with it. Investors, investment firms who manage large portfolios for their clients use FX market to facilitate transaction in foreign securities. For example, an investment manager controlling an international equity portfolio needs to use Forex market to purchase and sell several currencies in order to pay for foreign. So for foreign securities they want to purchase, say I want to buy stocks from the US, I'll have to use shilling, go back, purchase dollars, and after I purchase the dollars, I'll be able to buy the securities from abroad. So investors is very, very important. Then we have now the most important person, who is you, and that's why we are here for you, the retail trader or retail Forex traders. Finally, we come to you and I. The retail Forex industry is growing every day with an advent of Forex trading platforms. Here in Kenya, we are around 100,000 traders. So in the whole world, you are roughly 10 million. Retail Forex traders. So they are growing. The number is growing by the day with the advent of Forex trading platform and their ease of accessibility on the internet. Retail Forex access the market indirectly either through a broker or a bank. There are two main types of retail Forex brokers that provide us with the ability to speculate the currency. We have brokers and dealers. So that's why I was saying we have non-dealing and dealing. Dealing are the guys who are taking the position against you. Non-dealing, they set you straight into the market. It's like a bridge. That's what we'll be dealing. So us will be dealing mostly with the dealing, who are the brokers, so that you're able to have a platform to see how the market is working. And after that, you can trade and make something or a profit. So brokers work as an agent for the trader by trying to find the best price in the market and executing on behalf of the customer. For this, they will charge a commission. So when you're dealing with a non-dealing, mostly they make money with a commission on top of the price obtained. So if they give you a specific price, they may add 1 pip or 2 pips. I'll explain what is a pip later. Then that's how they'll be able to make money. So every time you're trading or making a trade, they'll make a small commission out of that. So dealers are also called market makers. You can see I was telling you about market makers because they make the market for you, for the trader, and act as the counterparty to their transactions. They quote a price they are willing to deal at and are compensated through the spread. So I need you to understand, for the market makers, mostly they will make money through the spread. Most of the time you'll see their spread may be a little bit higher than the normal broker, which is the difference between buy and sell, which I'll explain later. So I'm almost done with the introduction. Advantages, these ones I'll go through very fast. You can trade whenever you want. It's a 24/5 business, Monday to Friday. Ease of access. You can fund your trading with as little as $250 and begin trading the same day, straight through order execution. So you can use even your phone. So wherever you are, as long as you have an internet connection. Fewer currencies. So I also teach you you can focus. Me, I love gold and the Euro USD. They're really my favorite because I'm able to really understand what's happening in the US and Europe. And I'm also able to understand, in case there are things happening that are not favoring the dollar, I'm also able to hedge. Hedge means I'll be able to be buying the gold when the dollar is losing. Then fewer currency pairs to focus on. So for stocks, you may have a large portfolio, which can confuse you. So freedom to trade anywhere in the world, that one is there. Commission-free trading, many retail market makers have lower transaction costs than stocks. So another important thing is that your transaction costs are very lower than when you're trading stocks or commodities. They are very, very expensive. The other very, very important thing is volatility. The most important thing of why you're here or why you want to join this business is because there's always volatility, a lot of volatility, especially like the Euro USD, 80%, it's always moving. So you can always buy, sell, and make a profit. So volatility allows traders to profit in any market condition and provides for high probability weekly trading opportunities. Remember, our work is weekly. Every week we need to know, did we make a profit or did we make a loss? And of course, make a withdrawal, go treat yourself. So also, there is no structural market bias like long bias in the stock market. So traders have the opportunity to profit in rising or falling markets. So that's why I really love Forex, because I can buy or sell anytime, make a profit, get out, and I'm good to go. So while the Forex market is clearly a great market to trade, although to all beginners, the trading carries both the potential for reward and risk. Remember, reward and risk. There's a risk involved for you to get a reward. Many people come in the market thinking only about the reward. I know you want to make your first million, whether it's shilling or dollars. But first think about the risk. How much risk am I putting and how much reward will I be willing to take? And ignoring the risk involved. This is the fastest way to lose all your trading account money. If you want to get started in FX market on the right track, it's critical that you're aware and accept the fact that you could lose So the first important thing when you're beginning this business, always have in mind you can lose even the whole account. Sometimes things can happen, things go bad. Israel attacked Hamas during the weekend and you had your buy positions, then the dollar lost or something happened. So always have that in mind. But if you're able to follow your strategy with ice cold discipline, if you're able to have good risk management, risk kidogo kidogo, something small, 1%, 2%,